But that's one of the best risk rewards you'll ever be given in your career.
Absolutely.
What's amazing about crypto, why it generates so much wealth, is because you get repeatedly given these. That's why technology has done amazingly for people as well, technology investing. I know everyone on Twitter's flinging poo at each other, whether it's a recession or not, and the government stepping in. But basically, 2 quarters of negative GDP, not good. Usually that's given a 100% chance of a recession. We haven't had confirmation yet from things like the ISM survey, the Institute of Supply Managers survey. That usually drops to about 47. I'm expecting that in the next month or two. And then we'll be definitely there. So we're there or thereabouts. It feels that way. The markets have traded that way. We're seeing job cuts coming. You know, we're seeing a lot of evidence, and even the bond market's starting to tell us that. So it feels that the recession is here. Okay, firstly, the thing that gives you the best guide is something called the ISM survey. And you can Google it, you can find it, it's publicly available. And that basically, anything above 50, the economy's expanding. Anything below 50, it's kind of stalling. And anything below 47 is a recession. And that's been going since about 1947. It's an incredibly good indicator and really useful. So think of it as a kind of weekly version of GDP. So that gives you a very quick ballpark. And what's really interesting that no economists figure out, and I don't understand this, is it goes up and down. It's cyclical, right? Economists have linear projections. It's like, really? You see it going down and crossing 50, you know we're likely to be headed into a weak patch or a recession. If it's coming up from the lows, we can start looking forwards. So that's a really simple guide. The other way is the bond market's usually very good at this. So once yields start falling, bond markets are generally derive their price action from 2 things, GDP growth and future inflation. So if bond yields are rallying, it's saying that GDP is probably slowing down, i.e. there's a chance of stimulus to come and bonds look a safe haven. And secondly, that inflation is likely to come down in the future. So those 2 things alone give you pretty much all you ever need to know. Yeah, I mean, does technical analysis lead to price action or does it not? All I know is if you listen to Stan Druckenmiller over the last 20 years, every time he gives an interview, he says, you know where the economy is by looking at the internals of the stock market. What does he mean? It means things like consumer discretionary stocks versus utilities. If the economy is slowing, then discretionary stocks, i.e. the discretionary spending, tends to fall. Utilities are the things we have to have, so they tend to do well. They're all correlated with the business cycle. The business cycle, I mean, I've got business cycle indicators going back to 1870. They still work. So even though more people might look at them over time, I still don't think it's necessarily the driver of price action. If not, you would have seen more assets priced in the same move, but we haven't, right? We've got bonds up here, haven't priced in much of a weakening ISM, and then we've got tech stocks, which are at the bottom, which are priced in a massive amount of weakening. So it's clearly not efficient yet. Always at turning points, there is no consensus because there's a group that extrapolates the recent trend and says that's going to continue. And there's a group that extrapolates a mean reversion. Now, the question is here is more complicated because we've got these supply issues. We've got, onshoring. We've got other things that are muddying the equation. And what we've got is this big debate. So myself, David Rosenberg, and maybe Urian and a few others kind of think we probably mean revert because of debt, demographics, technology, that inflation's not a long-term issue. But there's a whole other group who I really respect who are saying, no, you're dead wrong. Inflation's sticky, it's here to stay, and it's a big problem. And we won't know, and this is the beauty of financial markets, right? It's game on now. We've got the game. We place our bets and we'll find out who's right and who's wrong. Yeah, all prices are set at the margin. And marginally, all prices are falling, except, well, even oil's fallen, but not as much as others. But stuff like copper that's very economically sensitive, been decimated. And we've seen that in agricultural commodities, we've seen it in all commodities. Now, Elon Musk tweeted out yesterday, somebody who'd been talking about the inflation in his supply chains said, we're seeing prices peak. Okay, he is a consumer of a lot of different raw materials.
That's right.
And he's telling us this. And we're seeing that all over the place. So, okay, so why is it at 9% now? Well, inflation is a lagging indicator. It looks back over prices. So still we're seeing some companies pushing through price increases of commodities that they bought 6 months ago that they've turned into cereal boxes that they've now put on the shelves, right? So it's a delayed process. And eventually the delay comes the other way. And it's the same with wages. So we're now just starting to see all the tech companies laying off people, all the crypto companies laying off people. So that's going to be pretty broad-based and pervasive. It's not gigantic because oil companies are doing well and other people are doing well, but that process then feeds through. So usually what happens is 18 months later, 12 to 18 months later, you get the reverse. And I actually think we go to negative inflation, which is not what anybody else thinks.
Right.
And I think that's right. So, you know, one of the things people talk about agriculture right now, you know, we're going to have this food crisis. Step back and look at the inflation adjusted prices of agriculture for the last 50 years. It's gone down. Why? It's gone down, even though the population of the world has doubled, it's gone down because of technology. So what people are saying right now is none of the supply issues can be solved by technology. But you know, because you're closer to it and where you're based, is that everybody's trying to solve it. So everybody's trying to solve, because there's supernormal profits in solving supply issues. So you focus your attention and your capital on solving it and you'll make money. So I don't know if equities have bottomed. My work suggests they should come a bit lower. But everybody else is starting to move towards we've got inflation, the Fed are going to go further, and therefore the equity market should fall 50% like it did in 2008 and 2001. And I'm just thinking, well, there wasn't quantitative easing yet. And their argument would be, well, how can they ease with inflation so high? I go back in history, they've always eased with inflation this high. You know, back in the 1940s, 50s, 60s, 70s, 80s, 90s, 2000s, they ease when inflation's at its peak. There is passing correlation because liquidity. So if we think what causes the correlation that we see right now, well, it's actually stopped, but the NASDAQ and the S&P, right? Liquidity and inflation, two big macro factors. That's the driver in the macro sense. But when you zoom out, there's no bloody correlation. Why? Because these are network adoption models. So they go up and to the right in a logarithmic channel over time. So the long term is a secular trend, which we don't see stopping. We don't see even the number of active addresses and all of those kind of measures of the network are much better than they were in 2018. Even the percentage declines. So we're seeing the network adoption, which is why every time we have the big sell-offs based on this liquidity, they're at higher prices every time. That's a great understanding we've now got. So where are we today? Fascinating. So we're right at the bottom of the liquidity cycle. So this is where, when M2 growth is negative, i.e. liquidity is coming out, assets should have sold off their most. So the next phase is the same as the bond yields falling, is we need more liquidity soon because we've got a recession coming. So the crypto markets sniffed this out 2 months ago and went, we know where this goes, because crypto is a very forward-looking asset. So the crypto market based, and that basing was exactly on the regression channel. It was exactly within, you know, all of these parameters, stuff like the 60-month exponential moving average, the 5-year moving average, exponential moving average, all of these measures, the most oversold RSIs in history, everything all happened at the same time. At the bottom of the liquidity cycle. It's like, okay, this is going to give you a very high probability, no certainties, that this is a low. In 18 months' time, are we going to have less money in the system or more money? The answer is 100% chance of more money. Because if not, we've blown up the entire world's economy. So let's say I'm wrong and there's more pain to come, which a lot of the crypto markets think. So let's say the downside is 40% from here. Okay, that's a decent sell-off from here. What is the upside? Well, every time you've gotten to the bottom, it's around 10x, maybe more. And depending which token you choose and how well you allocate your capital. So 40% downside, 10x upside, that risk reward is enormous. So that's one of the best risk rewards you'll ever be given in your career. What's amazing about crypto, why it generates so much wealth, is because you get repeatedly given these. That's why technology has done amazingly for people as well, technology investing, because people have this mean reversion mind frame and they think it's all over. The reality is it's always going up to the right, just within these volatile bands. So I'm going to make it easy for people. Everything is about supply and demand. Right? The more supply there is, the cheaper it is. The more demand there is, if supply is stable, the more expensive it gets. Which is why we've had the problem with prices, because there wasn't supply of oil, but there was demand as everybody came out of pandemic. So what have we got going on in ETH? We've got a gigantic supply shock. So what is the supply shock? The small supply shock is, right now, every day, miners are selling ETH. They probably sell 80% of everything they receive because they need to pay for their cash flows and their electricity and all of this stuff. So they stop. That's about 1 or 2 billion a month. Okay, that's nice. But then after that, we've also got the fact that staking's coming. Currently, there's about 9% of all ETH staked. Now, estimates are it should go up to around 30%. What does that mean? It means 30% of the ETH comes off exchanges, comes out of DeFi, comes out of CeFi, and is untouchable.
Yep.
Right, you're removing a gigantic amount of supply from the market. I look at this and think, holy shit, this is a massively imbalanced supply and demand situation. Barely, which I know everybody hates, right? Barely. Not because I don't like Bitcoin or don't think it goes up. I just think it goes up less.
Yeah.
You know,
Yep.
We're looking at this as a technology and a network adoption model. So you want to back the network that's growing the fastest and has the most number of applications.
Yep.
That's the safest, easiest allocation. That happens to be ETH. Now, other earlier stage tokens, whether it's Solana or AVAX or whatever, are getting earlier on the adoption curve. So you get that accelerated phase. So they'll probably outperform. But if you're just thinking the safe, easy bet, we're now looking at the internet. The money of the internet is ETH currently. Nothing is exchanged in
That's
Bitcoin.
Right.
I mean, literally nothing. What's left? Yes, it's not fast enough, so people go to other chains for that. It's a bit more expensive. People go to other chains, but the broad encompassing of the space, this is the simple, easiest bet to take.